Have you ever wondered how businesses decide how much of their overhead costs should be assigned to each product? Or how they spread things like rent, electricity, and factory expenses across everything they produce? That's where absorption rate comes in. Absorption rate is a concept used in accounting to determine how much overhead cost is allocated to each unit of production. In simple terms, it's the rate at which indirect costs like rent, utilities, and equipment are absorbed into the cost of making products. Think of it as a way of spreading shared cost fairly across everything a business produces. Let's make this really simple. Imagine a factory has £10,000 in overhead costs for a month. These are costs that don't directly belong to one product but are necessary to keep the business running. Now, if the factory produces 2000 units in that same month, the company needs a way to assign part of that £10,000 to each unit. So, they calculate the absorption rate. In this case, £10,000 divided by 2000 units equals £5 per unit. That means each product absorbs £5 worth of overhead costs. That £5 is the absorption rate per unit. Now, sometimes businesses don't calculate this per unit. They might base it on labor hours or machine hours instead. For example, they might say, for every hour of machine use, we assign £20 of overhead costs. The idea stays the same. The method just changes depending on how the business operates. So, why is this important? Because without an absorption rate, businesses wouldn't know the true cost of producing their goods. If they ignored overhead costs, they might price products too low and end up losing money without even realizing it. Absorption rate plays a key role in pricing, budgeting, and financial reporting. It ensures that all costs, not just direct ones, are properly accounted for when calculating profit. But here's where things can get tricky. Absorption rates are often based on estimates. A company might predict how many units it will produce or how many hours machines will run. If those estimates are off, the absorption rate can be inaccurate. This leads to something called overabsorption or underabsorption. Overabsorption happens when too much cost is assigned to products, meaning the company has allocated more overhead than it actually incurred. Underabsorption is the opposite, when not enough cost is allocated. Both situations can affect how profits are reported, so businesses need to adjust for them later. A common misunderstanding is thinking absorption rate is fixed and exact. In reality, it's often an estimate based on expected activity levels and it may need correction over time. So, what's the key takeaway? Absorption rate is the method businesses use to allocate overhead costs to each unit of production. It helps ensure that every product carries its fair share of indirect costs, giving a more accurate picture of what it truly costs to produce. And once you understand absorption rate, you'll start to see how businesses turn shared expenses into precise product costs and ultimately into pricing decisions.